Welcome to the Riskwiser Zone, the podcast where we delve into the world of stocks, finance, and risk management. I'm your host, Lewis, and I'm excited to have you join us today as we explore the fascinating story of the Wall Street crash of 1929 and its potential lessons for today's market. As we navigate the complex landscape of modern finance, it's essential to learn from history and understand the warning signs of a potential crash. Our guest, Andrew Ross Sorkin, has written an in-depth book about the 1929 crash, titled 1929: Inside the Greatest Crash in Wall Street History and How It Shattered a Nation. Sorkin, a renowned author and editor of DealBook, shares his insights on the similarities between the market conditions of 1929 and today. In a recent interview with 60 Minutes, Sorkin expressed his concerns about the current state of the market, stating that he believes a crash is inevitable, although he cannot predict when or how deep it will be. This sentiment is echoed by many experts who see similarities between the speculative bubbles of the past and the present. One of the key takeaways from Sorkin's book is the importance of understanding the role of speculation and greed in the lead-up to a market crash. In 1929, the stock market was fueled by excessive speculation, with investors buying stocks on margin and hoping to make quick profits. Similarly, today's market has seen a surge in retail speculative mania, with many investors jumping into trendy assets like meme coins and cryptocurrencies. Sorkin also highlights the dangers of unchecked market exuberance, where investors become so caught up in the excitement of making money that they ignore the warning signs of a potential crash. This is a lesson that remains relevant today, as many investors are eager to jump into the latest hot asset class without fully understanding the risks involved. Another critical aspect of Sorkin's book is the role of business leaders and their responsibility to speak out against reckless market behavior. In an interview with 60 Minutes, Sorkin noted that many CEOs are hesitant to criticize the administration or regulators, fearing reprisals or regulatory backlash. This lack of transparency and accountability can contribute to a culture of complacency, where investors become too comfortable and ignore the warning signs of a potential crash. As we consider the lessons of 1929 and their applicability to today's market, it's essential to remain vigilant and cautious. While it's impossible to predict with certainty when or if a crash will occur, understanding the historical context and warning signs can help investors make more informed decisions. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're exploring the world of finance and risk management, and we've got some exciting stories to share with you today. In our previous segment, we discussed the importance of diversification in investment portfolios. Now, let's dive into a fascinating story about Adani Ports and Special Economic Zone. Recently, UK-based Investec initiated coverage on Adani Ports with a buy rating, setting a target price of Rs 1715, which implies a potential upside of 23.5% from the previous closing levels. This move has generated significant interest in the market, and we're here to break it down for you. According to Investec's initiation note, Adani Ports' current valuation of 12x FY28 EV/EBITDA is attractive, considering the company's ability to deliver 13% EBITDA CAGR over FY25-230E from existing ports. The brokerage valued the stock at 16 times enterprise value to EBITDA for September 2027 to arrive at the target price. It's worth noting that Investec's discounted cash flow analysis of existing ports and businesses alone justifies the current market price, while the company's strong balance sheet offers significant optionality for future growth. The firm expects Adani Ports to generate operating cash flow exceeding Rs 1 trillion over FY25-2030, which should be sufficient to cover projected capital expenditure of Rs 700 billion and drive continued deleveraging. However, it's essential to consider multiple perspectives before making any investment decisions. Some analysts might argue that the target price set by Investec is overly optimistic, while others might see the potential for even further growth. As we always say on the Riskwiser Zone, it's crucial to approach investment decisions with a critical and nuanced mindset. We encourage our listeners to do their own research, consider multiple sources, and consult with financial experts before making any investment choices. In the world of finance, there are no guarantees, and every investment carries some level of risk. But by staying informed, being aware of market trends, and making thoughtful decisions, you can navigate the complexities of the financial landscape with confidence. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're closing out today's show with a story that's making waves in the financial world. J.P. Morgan Chase, one of the largest banks in the U.S., has announced a decade-long plan to invest $10 billion into industries critical for national security. This move is part of their broader security and resiliency initiative, which aims to finance or facilitate $1.5 trillion in funding for companies that are crucial to U.S. interests. Now, let's dive into the details. The bank has identified 4 key areas of focus: defense and aerospace, frontier technologies like AI and quantum computing, energy technology including batteries, and supply chain and advanced manufacturing. Within these areas, they've pinpointed 27 specific industries that they'll support with advice, financing, and investments. This includes everything from nanomaterials to spacecraft and space launches. J.P. Morgan's CEO, Jamie Dimon, emphasized the need for policy reform to accelerate progress, citing regulatory delays and workforce challenges. He also stressed that America needs more speed and investment to stay competitive. As he put it, "Our security is predicated on the strength and resiliency of America's economy." It's worth noting that this move comes at a time of heightened tensions between the U.S. and China. The announcement follows President Trump's decision to impose new tariffs on Chinese imports after China tightened export controls on rare earths. This development has significant implications for global trade and economic stability. As we analyze this story, it's essential to consider multiple perspectives. On one hand, J.P. Morgan's initiative could be seen as a strategic move to support U.S. national interests and promote economic growth. On the other hand, some might argue that this investment could be perceived as protectionist or even escalate trade tensions with China. As your trusted host on the Riskwiser Zone, I want to emphasize the importance of staying informed and nuanced in our understanding of complex issues like these. It's crucial to weigh the potential benefits and risks of such investments and consider their broader implications for the global economy. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.